So somebody, Bob, positioned the current situation as this. Bonds are falling like the Fed is raising rates again. Gold is rising like the Fed is aggressively cutting rates. Oil prices are falling like we've entered recession. Stocks are rising like the bull market just started. Home prices are rising like inflation is rebounding. Mortgage rates are rising like the economy is strong. Did the Fed break the market or something here?
Welcome to the challenge of macro investing and trading, right? All of those cross currents all at the same time, and you got to navigate all of them. I think most of the things that you're talking about are really related to the Fed transitioning to pursuing over easy monetary policy. When you have a economy that continues to experience inflationary pressures and then you aggressively ease, either the economy can run hot and that'll create essentially bond yields selling off and mortgage rates rising and things like that, and inflation concerns, which often get reflected in gold. Or what can happen is the markets can basically get ahead of that. And so I think that's what we've seen really over the last 6 or 8 weeks, is that financial markets are looking at what the Fed's doing and they're saying money's too easy in the US, but also globally as we see the global easing transpire. And as a result, we're going to get ahead of what we think the likely macro implications are of that dynamic. I think the main outlier is in the oil market, which honestly, since 2016 has traded a bit idiosyncratically, particularly related to supply elements. And so I don't think it's necessarily a great indication of demand or inflation pressures, and much more around where incremental supply is coming into the market.
Interesting. Okay, so let's stay on the market here. And in the market in March of 2000, Cisco and all the tech stocks, they were in a massive bubble. Cisco made up 5.5% of in all of GDP, and that was at the peak. Today, NVIDIA is worth 11.7% of US GDP. That's right now. So that's more than double where Cisco was during the biggest stock market bubble since the one that kicked off the Great Depression. How concerned are you about this, and what are your expectations for these high-flying tech stocks moving forward? Are they in a bubble?
I think when you look at what expectations are priced into the Mag 7 or other tech stocks, particularly related to AI, it's going to be quite challenging to achieve the sort of growth that's currently priced into the market. In order to achieve their expectations, you not only have to see, incredible productivity growth, which drives additional sales growth, and incredible investment growth, multiples of even what, reasonable people are penciling out. But you'd also have to see it drive huge margin expansion across the equity market. And I think one of the challenges with any expectation of margin expansion is when margins expand, it basically means that labor gets paid less relative to their overall demand. So somebody's got to make up for that. And so either households would have to save to make up for that, or the government would have to go run even larger deficits than we're already running, both of which are pretty implausible when you think about the extremity of it. And so there's no doubt that expectations are likely unreasonable across many of those tech stocks. The question is, when do bubbles pop? Because you can become quite poor shorting bubbles as they get more and more extreme. Typically, when you look back through time, what causes bubbles to eventually pop is a central bank tightening of one form or another. It certainly happened in the 2000 case. It happened in the 1929 case. It happened in the 2006 to 2008 housing crisis. And so I think we're in a challenging circumstance for the, let's say, the rational investor, seeing very elevated valuations across those stocks and very high expectations, but a circumstance where the Fed is easing that typically would not lead to that bubble being popped quite yet.